I'd like to introduce our moderator, Brendan Walsh. Brendan is the CSH tax leader and a shareholder who specializes in tax consulting for businesses and their owners. His work focuses on strategic tax planning to minimize tax exposure, specializing in fixed asset strategies, depreciation, cost segregation, and tangible property regulations in the construction and real estate industries. Brendan has worked with companies ranging from small startups to billion-dollar publicly traded entities. I'll pass it off to Brendan to get things started and introduce our presenters.
Thanks, Allie, and welcome everyone and good afternoon. Again, my name is Brendan Walsh, and it's a pleasure to get to speak with you all today and provide this webinar. I want to first thank you all for joining us and welcome you to the first of our 2 year-end tax planning webinars. Of course, today's webinar focuses on year-end tax planning for businesses. Now, next week on Tuesday, December 10th, we will be hosting our year-end tax planning webinar for individuals. So if you haven't yet registered for that event and would like to, there is a link in the resource list feature of this webinar. That should be the gray box that's on your screen. So with that being said, I'd like to introduce our first presenter, Zach Gubser. He's a tax shareholder who works on compliance, planning, transaction, and controversy projects for clients ranging from individuals to pass-through entities, as well as large multinational corporations. Zach has a wide array of industry knowledge and a great deal of experience working with manufacturers as well as service companies. Zach focuses on strategic planning opportunities and minimizing tax exposure for his clients. Brittany Lawrence is a tax shareholder as well, who focuses on business tax planning and compliance. In addition to multi-state experience, Brittany's industry focuses include real estate and manufacturing. She helps clients fulfill compliance requirements of the various taxing authorities while minimizing tax implications and providing valuable tax planning strategies, including multi-tiered partnerships and Section 1031 like-kind exchanges. Brittany works frequently with the IRS and the state of Ohio, resolving conflicts and assisting clients with audits. And then our third and final presenter is Phil Hurak. He's a managing shareholder of Clark Schaefer Consulting and the leader of our state and local tax practice. Phil thrives on change and leveraging it as an opportunity to create value and minimize risk for clients. Throughout his career, Phil has used his legal, business, and consulting expertise to deliver measurable results for businesses, from family enterprises to Fortune 500 clients. Now, before we begin the presentation, we do have our first polling question that I want to go through with everyone. So you can see it there on the screen. Are you confident that your organization has the resources and support to navigate the evolving tax landscape? A, yes, we have it covered. B, we're somewhat confident. Or C, no, we could use some help. So we'll give you a few seconds there to answer that first polling question. Now, while you're working on that, just as a reminder, please submit any questions that you have using the Q&A button on your screen. As we go through the presentation, we will track those questions and answer as many of them as we can at the end of the presentation, time permitting. Okay, so now we will go ahead and go through the agenda. First, Zach Gubser is going to provide the federal legislative update. Then Brittany Lawrence is going to talk through tax planning strategies and planning considerations, where we are now in 2024. And then finally, Phil Hurak will discuss state and local tax updates and some additional updates for us. So with that being said, we will get into it, and I'll turn it over to Zach Gubser.
Thanks, Brendan. As mentioned at the outset, my name is Zach Gubser. I'm a shareholder in the tax group here at Clark Schaefer. My plan today is to give an overview of the current tax legislative landscape, as well as an overview of where we may be headed. And may is the operative word in that sentence, is at this point, we don't have a ton of specifics. I'll do my best to highlight what we do know and what we do think is going to happen. But at this point, again, we're light on details. So jumping right in, I'm sure you are all aware that 1 month ago, elections were held across the country. Most of the results are in at this point with the following outcomes. Donald Trump won the presidential election. He had 312 electoral votes. Republicans regained control of the Senate. If you look at the registered independent leadings and the party that they're going to caucus with, it shakes out to be a 53-47 Republican majority. The House is a little bit different. Republicans narrowly held control. Last I checked, it's actually 220 seats to the Republicans, and the Democrats are up to 215. So a slight majority. And ultimately, what does that mean for us? With control of the executive branch and with simple majorities in the House and the Senate, the Republicans will be able to push some of their priorities, but they do not have the filibuster-proof majority that it would take to enact expansive legislative change. We're going to get to this in a little bit more detail when we're talking about policy, but with the simple majorities, we expect the tax legislation in 2025 is going to come through the budget reconciliation process. And to that end, Speaker Johnson, the House Speaker, recently said that tax reform is going to be a major priority early in 2025, but you've got to do the math. And do the math is one of those key components of the budget reconciliation process. However, just earlier this week, the Wall Street Journal reported on Tuesday, the incoming Senate Majority Leader, John Thune, outlined a plan in which Congress would address the border security, energy production, and the military first, and shelve tax policy until later in 2025. It looks like it'd be September under that plan. So it does seem the question is when, not if, we're going to get tax reform. Me personally would love to see it a lot earlier than later, but we'll see what Congress does. So how do things look right now? First, I think it's important to talk a little bit about what happens if nothing happens in Congress. Leading up to November, it seemed like this could be a very real scenario, but with one party controlling Congress and the executive branch, it seems like something's going to happen. A divided government probably would have had gridlock, and we may be dealing with some expirations at the end of 2025. So if we rewind the clock back to the early years of the first Trump administration, we get back to 2017 when Congress passed the Tax Cuts and Jobs Act. It was a major tax reform bill, the most recent one we've had. By and large, the law contained tax cuts for businesses and individuals. However, given the quirks of the budget reconciliation process, some of the cuts in the provisions were sunset or they expire in the future. Many of you have been dealing with some of those sunsetting provisions over the years, but when we get to January 1st, 2026, or December 31st, 2025, however you look at it, that's when we see some of the most significant rollbacks of those TCJA provisions. Again, even though we do expect major tax reform in 2025, I think it's important that we're going to go through what would happen if Congress does not act, because a lot of these, I think, are going to serve as a baseline for what we may see in 2025. So if Congress were to do nothing, what are some of the major changes that we'd see at the end of 2025? The reduced individual income tax rates that we're enjoying right now reset to higher levels. And not only do the rates increase, but the brackets get compressed. So higher levels of income start getting, or lower levels of income get taxed at higher rates. I know this is the business tax webinar, but that would impact all of our pass-through entity owners like partnerships and S corporations, as well as sole proprietors. And as Brendan mentioned, any of you who are interested in a more detailed discussion about the individual tax planning, there's the Clark Schaefer Hackett year-end tax planning for individuals webinar next Tuesday, December 10th at 2 p.m. So be sure to tune into that. But what else do we expect, or what else would we see on the business front? Section 199A is set to expire. For most of our pass-through entity owners or sole proprietors, this would be a major change. Generally speaking, Section 199A is the provision that allows pass-through entities to deduct up to 20% of their qualified business income. So what does that really do? In effect, the current top tax rate on individuals right now is 37%. If you get to deduct 20% of your income, your top tax rate is effectively 29.6%. So if 199A expires and that 20% deduction goes away, and if the individual income tax rates also jump back up, the effective tax rate on pass-through income, the top effective tax rate, goes from 29.6 up to 39.6. And obviously, that's just a massive tax increase on many small businesses. It would be hard for a lot of people to deal with. Continuing on, Brittany will talk a little bit more about this, but as it's currently set, bonus depreciation is at 40% for 2025, goes to 20% in 2026, and then it's gone in 2027 and beyond. So it continues to sunset until it's eliminated for 2027. Obviously, that reduced ability to immediately expense capital assets impacts the after-tax cash flows of the business and just have a major impact on the business operations and after-tax cash flow. So what else? Absent any congressional action, the SALT cap goes away. And when we refer to the SALT cap, that is the $10,000 limit on the state and local tax deduction on individual income tax returns. Since 2017, the cap has been the target of all sorts of press and a huge legislative issue. Many of the high state income tax senators and representatives have been pushing for a repeal. So far, they've not gotten it. What some states have done in response to the inability for individuals to deduct income taxes is implemented what we and all practitioners call the PTET regime. It's essentially an end around that allows the owners of pass-through entities to have the tax paid at the entity level. They get a federal tax deduction at the entity level, so they're going to benefit from the deduction even though it's capped at their individual level. And Phil will go into that in a lot more detail. And then given that the default is the expiration of the SALT cap, so people will be able to deduct their state taxes if nothing happens. And with the ultra slim majority in the House, it seems pretty likely that blue state Republicans are going to hold the line on removing the cap. Whether that also comes with a re-implementation or a more significantly impactful alternative minimum tax is yet to be seen. I think Mark and Larry will probably talk about that in a little bit more detail, but the circle of people who care about the SALT cap, I think, is very big. The circle of people who understand in detail the alternative minimum tax is pretty small. And the overlap of those people, I'm not sure that there's much there on that Venn diagram, because the alternative minimum tax for a lot of upper middle class people was wiping out some of that state income tax benefit anyway. Last big sunsetting provision I'll point out is the increased estate and gift lifetime exemption. Congress roughly doubled those exemptions in 2017, but absent any congressional action, those exemptions fall back to roughly half of what they are now. Again, tune in on Tuesday and you can hear a lot more about that. But those provisions may have a significant impact on succession planning and family business planning certainly for our clients. In that list I just ran through, those are the provisions of the 2017 TCJA that change absent congressional action. But there are some provisions from that law that remain in place if Congress does not act. Some of those major issues that our clients have been dealing with, absent any action from Congress, the Section 174 limitation on the deductibility of research and development expenses, that stays in place. So as many of you know, R&D expenses must be capitalized and amortized over 5 years if they're incurred in the U.S., 15 years if they're incurred outside the U.S. This was a surprise to many taxpayers, and most practitioners thought this was going to go away before it would ever be implemented. We're still hoping it goes away, but many of you are capitalizing your R&D costs rather than deducting them at this point. Second, we have the 163J limitation on the deductibility of business interest. Initially, the deduction for business interest was limited to, it was essentially 30% of EBITDA. There was some COVID relief over the years, but today the deduction is now limited. It's essentially 30% of earnings before interest and taxes. We lived through, I guess we're still living through a perfect storm where the interest rates are increasing at a historic pace, or have increased. We're getting some relief now. All the while, the rates, interest rates are increasing. The ability to deduct the interest that's being paid is being limited, coupled with all the other tax changes, and it's just, money going out the door for interest, and then you're paying more tax when you get down to it. And like with the SALT cap and the R&D limitation, we did expect some relief over the years, and that relief never came. So here we are today, still talking about hopefully getting some relief. One, I guess I'd call it a beneficial change. The corporate tax rates with the TCJA, they were lowered from a top tax rate of 35% down to a flat 21%. So at the lower end of the spectrum, this was a little bit of a tax increase potentially, but at the end of the day, it amounted to a pretty large cut in corporate rates. Absent congressional action, that rate still stays at 21%. All right, so with all that in mind, if nothing happens, what do we expect over the coming year? Well, tough to say, but if you looked at the Trump campaign website, you will see the word tax twice. It's one line amongst 20 core promises they have listed, and it says large tax cuts for workers and no tax on tips. So while I welcome the sentiment, that doesn't give us a whole lot to work with. Recent reporting on discussions amongst the Trump advisors and House Ways and Means Committee indicates they are pushing for that tax cut on tips. I don't know. I think that's a headline grabber. I don't know that it's really going to have much of a practical impact, but just one of those things. If it's not in the tax legislation, that'll be all the headlines. We'll talk about process on the next slide, but there are some procedural nuances that may limit what Congress can or has the willingness to do, and whether that's eliminating tax on tips or anything else discussed on the campaign trail. They do have to work within certain defined parameters. Aside from the campaign website, when it came to taxes, we heard a variety of ideas. Some of these have been adopted into the official Republican Party platform. I do think it's more accurate to call these guiding philosophies, not campaign promises. Generally speaking, I think there's a lot of talk out on the campaign, and we may get some version, but I think these may just be guideposts for what we will ultimately see. But amongst those ideas, extension and expansion of the 2017 tax cuts. That's why we just ran through that list on the previous slide. Trump has expressed a willingness for an extension and expansion. The Republican Party platform has adopted that position as part of its official platform, wanting to make some of those cuts permanent. But I think most people, when you look at this, are going to view things like the 199A qualified business deduction as a baseline of what's necessary. So if they fail to extend a 20% deduction, I think people are going to view that as a tax increase as opposed to an extension of the 199A deduction. I don't think people are going to view that as a tax cut at this point. We've also heard Donald Trump talk about a reduced corporate income tax rate. Again, we don't know what that will be. Different rates have been floated, whether it's 20%, 15%. And then ultimately, if there is a lower corporate tax rate, or if the corporate tax rate does change, you also have to look at the tax base. And are there other changes coming to what can or cannot be deducted by a corporation that would increase or reduce their effective tax rate at the end of the day? So, we can grab the headlines or look at the headlines with the tax rates, but whether or not those tax rates actually impact the effective tax rate the companies are paying would yet to be determined. Again, elimination of the tax on tips has been floated, along with elimination of income tax on overtime and Social Security benefits. Repeal of the SALT cap, we've touched on that. That's been discussed ad nauseum. Implementation of tariffs to offset revenue losses is another thing that's been floated. They've been a huge discussion point. We'll get to this in a minute, but the ability to offset revenue losses with tariffs may be limited by some of the procedural hurdles with the budget reconciliation process. One last item, they've discussed incentives for domestic manufacturing. So to be seen what that looks like. I think it's a little early to predict specifics, but there does seem to be a willingness to reduce taxes, or at least keep rates where they are, as well as incentivizing domestic manufacturing. So whether that comes in the form of an extension of 199A, qualified business income deduction, or some other form, it's yet to be seen. And if you remember to what I had said on the previous slide, corporate tax rates, if Congress does nothing, corporate tax rates stay at 21%. And if Congress does nothing, the top rates on pass-through income jump back up to 39.6%. I don't think Congress is going to be willing to accept a regime where taxes on small businesses and pass-through income are at 39.6% and corporate tax rates are at 21%. And even if you factor in the second layer of tax on dividends out of the corporation, you're still much better off in that scenario from a pure tax standpoint, likely being a C corporation. When it comes to incentivizing domestic manufacturing and domestic growth, it's going to be interesting to see what form that takes. Some of you may remember back to the pre-TCJA years, there was, I think it was actually Section 199, but it was the domestic production activities deduction. That was a deduction from your taxable income for income derived from domestic production activities. So whether we see a resurrection of that regime or some other incentives for domestic manufacturing or domestic business activities, yet to be seen. And then if the SALT cap is repealed, we'll need to see in what form that comes, what form that takes, and if the alternative minimum tax is brought back in full force to wipe out some of that benefit. If that's the case, maybe the PTET regime, even if PTET was in response to the SALT cap, but if they lift the SALT cap and bring back AMT, maybe PTET still is a very beneficial thing for pass-through entity owners. A very brief side note as we talk through all this, there was a lot of talk during the campaign season about a potential tax on unrealized gains or a wealth tax. I don't think we're going to see anything like that in the near future, but back in June of 2024, there was a Supreme Court case, Moore v. United States, and they explicitly left the door open to a potential wealth tax or a potential tax on unrealized gains. If you think the 16th Amendment authorizes Congress to lay and collect taxes on income. What hasn't been fleshed out yet is whether that income can be unrealized. So you own some stock in a company and the stock just goes up in value, or if that income has to be realized, meaning that stock increased in value and you sold it. So the Supreme Court explicitly punted on that realization issue. So I did think through the campaign season, if things shook out differently, there was potential that we could see some taxes on unrealized income that would eventually, no doubt, ended up at the Supreme Court. But I think that's a fight that's going to be fought at a later date, if ever. Another Supreme Court case that we were heavily focused on was Loper Bright Enterprises v. Raimondo. Some of you may know about this. It's the case that got rid of the Chevron doctrine. We're not going to go into all those details. Suffice it to say, that case is going to have a major impact, most likely on a lot of administrative agencies. But Treasury typically has been pretty good following the Administrative Procedures Act when issuing regulations. They've been pretty good laying out their reasoning and the preambles to the regulations that they're issuing. So with that, coupled with Congress has typically given Treasury some express grants of regulatory authority when they are passing legislation, I think Loper Bright is going to have a very large impact on regulatory agencies, but from a tax policy standpoint, probably not as much as we're going to see in other places. So we've talked about policy now. What's the procedure process going to look like? Though a lot is unknown, it's almost certain at this point that when tax reform comes, if and when it comes, it's going to be through the budget reconciliation process. That process, it allows for certain legislation to be passed with a simple majority, and you get around the potential for a filibuster in the Senate. It's actually the way the TCJA was passed back in 2017. The American Rescue Plan Act, I think that was 2021. The COVID-related legislation, it was also passed with budget reconciliation, and same with the Inflation Reduction Act. Those are all in recent years. We're not going to go into all the nuances of budget reconciliation in the legislative process, but one important requirement is the budget reconciliation process. The bills cannot be projected to increase the deficit past the budget window. The budget window is typically 10 years. And one other item, too, I think to note is the budget reconciliation process cannot impact Social Security. So when we talk about no tax on tips or no tax on overtime, whether or not that eliminates the Medicare and Social Security for employee or employer, or it just impacts the income tax withholding on those, is to be determined. They probably cannot eliminate the Social Security piece through the budget reconciliation process. And not increasing the deficit over the budget window, that means for any potential revenue decreases from tax cuts when they're doing the scoring, Congress is going to need to offset those decreases with spending cuts or revenue raisers elsewhere. This is exactly why certain provisions of the TCJA were scheduled to sunset or expire. The legislation needed to be budget neutral. Congress chose to limit the time period of certain provisions, like the bonus depreciation or 199A, just to keep it neutral over that window. There's potential that that's what we see again. Some sunsets and new legislation, expiration, but yeah, obviously we would all love to see a bit of permanency to the extent anything is permanent in Washington, but we don't really want to be sitting here in whenever the expiration of this new tax reform is, wondering what's going to happen as we come into the new year. Alternatively, Congress, rather than sunsetting tax cuts, could find areas to cut spending. It's been floated that they'd repeal portions of the Inflation Reduction Act. If any of you have looked at that, it's essentially a green energy bill. Has a lot of green energy credits and some spending in there that has been floated as one area that they could get some savings. As mentioned earlier, tariffs could be another revenue raiser, but it's important to point out when we're talking about spending cuts or tariffs as part of the budget reconciliation process, those need to be done through legislation if they're going to count against any revenue decreases. Historically, Congress has delegated pretty broad authority to the president to implement tariffs for a variety of reasons. However, if Trump is to come into office and implement tariffs unilaterally, which again, he likely has the authority and the flexibility to do that. Presidents before him have done it. He did it. Biden has done it. But if the president does it, any potential revenue from those tariffs is not going to be counted as an offset to decreases to legislation through the budget reconciliation process. So if tariffs are going to be something that's used as a revenue raiser to help offset the tax cuts, that needs to be done through legislation and included in the budget reconciliation. Just so to summarize everything I just said, the TCJA, it's probably going to serve as a baseline for the tax reform in certain instances. So I think it's important to know what the baseline is today, where we would be going absent any congressional action. But given the procedural hurdles, Congress is going to have to find ways to offset projected revenue decreases with spending cuts or revenue increases. Potentially that's through sunsetting cuts, potentially through spending cuts or tariffs. But with the very slim projected majority in the House, Republicans are going to need to find a way to get near unanimous consent for anything they're doing. I think probably means the SALT cap is lifted, but I think when you're talking about getting near unanimous consent, trying to make everyone happy, I think we're going to get probably a lot of some more complexity. A lot of us would love to see a simplification of the tax code, but when you're going through trying to pick off every single representative in the House and satisfy them, I would imagine we're going to get a little bit more complexity baked into the tax code as opposed to any more simplification. So with all that said, what do you do now? At a very minimum, understand your current structure and how you're operating under the current tax regime. If you're currently benefiting from 199A, or if you're subject to the business interest deduction limitations, or anything else under the current law, your R&D expenses are limited, just know where you are so that if there are potential changes or if there are changes, how are those going to impact you? And we're always happy to have those conversations with you. And as noted at the outset as possible, Congress may not act on tax legislation until September. I say possible. I think at this point that may be likely. That gives limited time to make adjustments or to respond to any tax legislation. So don't let this be something that in November or December of next year, you're just thinking about tax planning. Understand where you are now. And then next point, stay informed throughout the year. Most of you probably get our emails. If not, go to cshco.com. I think if you scroll to the bottom, you can sign up and you'll get on the email list. But at a very minimum, make sure you're getting those emails. Stay in touch with anyone you're working with here. We will be ultra hyper focused on the legislative process throughout next year. As ideas are being floated, as things look likely, or more likely, or less likely, we will be on top of that throughout the year. So stay in touch. At minimum, read what we're sending you. Always best to have conversations there throughout the year, and we're happy to have those. And those first 2 points, those are about being prepared for what's coming. Whether you've got to do new borrowing, or refinance, or whether you've got research and development you need to do, or capital expenditures, any other business decisions. The tax law over the recent years has, I think, had an outsized impact on those decisions potentially, or at least the impact of those decisions. I'm not one that's generally going to sit here and let the tax tail wag the dog, but as we do get a clearer picture, some of these things will have a massive impact on after-tax cash flows. So you got to know what the impact is going to be on your business from any changes that are made and how best to respond to those changes. So with that, I think I'm going to go to the next poll and hand it off to Brendan.
Thanks, Zach. That was great. Yeah, so here's our next polling question, folks. Is your organization leveraging tactics like tax deferrals and income shifting? A, yes, we have a solid strategy in place. B, we could do better. Or C, no, we want to learn more. Go ahead and answer that polling question. We'll give you a few moments here. And like while you're answering that, like Zach said, it's quite an interesting time in tax, and for those of us that are in this profession, this is what we live for. We love to have these discussions and talk through those issues that you're seeing in your businesses. So as questions come up, again, please reach out to us, and again, we're more than happy to have those discussions and maybe talk through specifics about how you could be impacted. Okay, so now we will go ahead and turn it over to Brittany Lawrence, who will give us some discussion items on tax planning strategies and planning considerations where we are now in 2024. Brittany.
Yeah, thanks, Brendan. So now that Zach has taken us through a legislative update, I'm going to be digging into some tax planning strategies and planning considerations for you and your business in 2024. And I'll make the note that none of the concepts that I will be discussing are new for 2024. However, they still really are relevant to your year-end tax plan. So first, let's touch base on tax rates here, because as Zach mentioned, as of right now, there will be a few changes taking place after tax year 2025. Zach touched on this previously, but just a reminder, corporate rates under TCJA were permanently, and permanently is in quotes, lowered from 35% to a flat 21%, and that applies to C corporations. And this was technically permanent, but it's kind of all relevant in the tax world, really just as permanent as the next administration or Congress that is willing and able to change it. Individual tax rates, which includes owners of pass-through entities, currently have a top ordinary rate of 37% through the end of 2025, when it's set to sunset and return to 39.6 top ordinary rate, as Zach had previously talked about. Many of our clients have their entities structured as S Corps, LLCs, partnerships, which really means that taxable income is taxed at the individual level at this individual rate. But again, don't forget about the 20% deduction under Section 179 or 199A for qualified business income, or QBI, which we have through the end of 2025. And again, this was created back in 2017 by the Tax Cuts and Jobs Act. And really it was to create rate parity between C corporations and pass-through entities such as S Corps and LLCs, kind of with the goal of leveling the playing field, if you will, between C Corps and those pass-through entities from a rate perspective. So again, if you factor in that 20% 199A deduction, the top rate on qualified business income is really 29.6, which is 37% times 80%, which factors in that 20% QBI deduction. On the next slide here, capital asset planning is a tried and true tax planning strategy used by many businesses every year to accelerate tax deductions into an earlier year by using either bonus depreciation or Section 179, or a combination of both if it's available. So some questions you may want to ask yourself: are you considering purchasing equipment, furniture, machinery before year end? Or have you already purchased capital assets and you've not yet placed them in service? You may want to go ahead and do that before year end so that you can claim a depreciation deduction. Bonus depreciation is one of the methods to write off capital assets sooner for tax purposes. And I'll make the note that bonus depreciation is currently at 60% for 2024, and that does continue to phase down by 20% per year with no bonus available in 2027. So this means that in 2024, you'll be able to write off 60% of the cost of eligible property for tax, and the rest of that is depreciated over normal methods. Eligible property for bonus is going to be personal property with a less than 20-year life, and it can be new or used property. Also make the note that bonus can take your business into a loss situation. But you will want to watch out for state decoupling rules, as many states, which includes Ohio and Kentucky, they won't give you the same benefit at the state level that you'll get in year one on the federal return. The chart on the left side of the screen here summarizes the various bonus depreciation levels depending on when that asset is placed in service. And again, this is under current law and assumes no tax extenders or tax changes package, which you may recall was a hot topic back in early 2024. It seemed like 100% bonus would be back in play for 2023, but ultimately that did not happen and that bill did not clear Congress fully. A planning tip to consider here, if you have vehicles that are used for business that weigh over 6,000 pounds, so think heavy trucks and vans or SUVs, there still is no limit on bonus depreciation under the luxury auto caps, so you could take 60% bonus on a vehicle in this category that is used for business and placed in service in 2024. Section 179 is another strategy to consider when you want to pull tax deductions into 2024. And it has a max of 1.22 million in 2024, and it will begin to phase out if you have 3.05 million of total personal property purchases or more. This deduction is a little bit different than bonus in that it allows you to fully write off the cost of qualifying purchases, such as machinery and equipment, but it cannot take your business into a loss situation. The chart on the right side of the screen here shows the different levels of both bonus and 179 for 2024, as well as looking forward to 2025. Cost segregation study is another tax planning tool used by many businesses, in particular when they acquire or rehab a building. This study allows a business to segregate a portion of the total building cost into shorter-lived assets, and therefore accelerating tax depreciation over a much shorter time period. So think 5, 7, or 15 years instead of the normal 39 years for commercial property. But you will want to watch out for the limitations on the usage of those losses that may be generated by bonus depreciation at the individual level, due to some various types of limitations that come into play at the individual level. So it's important to model out those losses to make sure there aren't any surprises when tax time comes around. Moving on here, we wanted to cover a couple of key pass-through entity considerations for 2024, as many of our clients are organized as pass-through entities. First, you want to evaluate if your business has any R&E expenses, research and experimentation, or research and development expenses. And remember, as Zach mentioned, that those are required to be capitalized and amortized over 5 years, and that began in 2022. This treatment, as many of you know, has been the subject of much scrutiny this year. Earlier this year, there was a bill that would have removed that requirement to capitalize the expenses and allowed the deduction again, but ultimately did not pass through Congress. So this will be something many companies, clients, tax professionals are watching closely going into 2025. The business interest expense deduction limit. So this is a limitation that may come into play for your business. The limitation calculation is now based on EBIT, which is earnings before interest and taxes. So we're now finding more businesses get caught in this limitation now that depreciation and amortization are not an add back in the calculation. Previously, that limit used to be based on EBITDA, and now it's based on EBIT. So this is basically a limit on the deduction of interest expense to 30% of the taxpayer's adjusted taxable income. So a planning point here, first, find out if you're even subject to this special limitation. Smaller businesses that have less than 30 million in revenue really don't have to worry about it. Also, real property trades or businesses could consider a special election to get out of these limitations if your business falls in that industry. Excess business loss limitations, or EBL, is a limitation that will cap the amount of business losses that you're able to take in 2024. And that will be to $610,000 for married filing joint, and all other taxpayers will be limited to $305,000 for 2024. So this is a limitation that comes into play at the individual level for excess losses from a business and anything over that cap is essentially carried forward as a net operating loss. So at year end, you will want to consider, is there any planning that can be done to limit the negative impact of this limitation? You will also want to take a look and consider the impact on your estimated tax payments. So maybe you will not be able to fully write off the loss from your business, and you may need to consider paying an estimated tax payments for Q4 by January 2025. Basis and passive activity limitations. So I mentioned this briefly when discussing cost seg studies, but this could be a potential gotcha moment for some clients when their business has experienced losses in 2024, maybe because of an accelerated tax deduction or perhaps a decline in revenue. And those taxpayers may be expecting those losses to offset some of their other types of income, such as wages. Owners can only write off losses to the extent of basis, and there are several levels that you must clear before writing off that loss on your Form 1040. And that would include tax basis, at-risk basis, and passive activity limitations, which comes into play if you're not active in the business. So if you're in this situation, it would be a good idea to reach out and discuss with your tax advisor and model it out before year end to see if there's any planning that can be done. Next, I'll cover a few tax deferral and income shifting strategies to consider for your business. First, I'll make the note that this should be a multi-year strategy, meaning that you'll want to evaluate what is your current tax rate now and what do you expect it to be in 2025. Traditional tax planning will focus on accelerating deductions into 2024 and deferring income into 2025. And this strategy works well if you expect to be taxed in a lower or the same tax rate in 2025 when compared to 2024. So maybe your business is very consistent and you expect to be in the same tax bracket in 2025. This is a case where you'll want to use traditional tax planning strategies. Or maybe you just started your business in 2024 and you expect 2025 to produce higher taxable income. You'll want to consider the reverse of traditional tax planning by pulling income into a lower tax rate year and deferring deductions to a high rate year so that you can get those deductions at a higher rate. One strategy to consider is evaluating your receivables and or inventory to generate a tax deduction for any uncollectible receivables or maybe some worthless / subnormal inventory. So you'll want to review your AR ledger to see if you have any specific receivables that are uncollectible. And then by using a specific identification method, you'll be able to determine which of those specific customers to write off in 2024 as uncollectible. The same type of process is used to write off worthless or subnormal inventory for tax purposes, again, using that specific identification method. Another strategy you may want to consider is accelerating the payment of your year-end bonuses. So you may want to pay those bonuses in December if you are a cash basis taxpayer in order to get that deduction in 2024. But if you are a accrual tax basis taxpayer, you'll want to be aware of the 2.5-month rule, which means that calendar year taxpayers generally have until March 15th, 2025 to pay bonuses and still deduct them in 2024. Also be aware of the special rule for S-Corp owners and bonuses. No matter what accounting method here is used, the corporation is not able to deduct the bonus until compensation is included in the owner's income, which effectively is going to put even accrual basis S-Corps on cash basis for this specific purpose. You could also evaluate LIFO if you have inventory costs which are rising significantly. You could also take a look at accrued liabilities to accelerate payments. Again, this is the 2.5-month rule for reoccurring expenses. If paid by March 15th, 2025, you can deduct those in 2024, assuming it's not going to a related party. Also, retirement plans are another great way to reduce your overall taxable income. There is an opportunity to establish the retirement plan before the end of the year and not fund that contribution until the filing of your tax return in 2025, including extensions, and still get that tax deduction in 2024. Another longer-term tax planning strategy to consider if you're an owner of a closely held business is the gifting of business interests to the next generation. This conversation is especially important in light of the scheduled sunset of the estate exemption, which is effective January 1st, 2026. This type of planning is very powerful due to the utilization of valuation discounts, which is a great way to pass along additional wealth to the next generation. Also consider gifting to a family trust because that's going to remove future appreciation of the family business from your taxable estate. And as previously mentioned, the estate gift exemption is scheduled to decrease on January 1st, 2026 to about half of what it is now. And the IRS has said there is no clawback for proper gifts prior to that time period. So important planning point here is you need to start thinking about this now. Many steps need to be accomplished and you really cannot wait until late in 2025. Need to get some business valuations, trust set up, various legal documents. So important to start thinking about that now. And as mentioned previously, there is a CSH webinar next Tuesday, December 10th, where we'll go over a lot more details in regards to this topic. So stay tuned to that if you're interested. So with that, I'll turn it over to Brendan for poll number 3.
All right, thanks, Brittany. Polling question number 3 here. Is your organization proactive when dealing with nexus creating activities and the tax implications? For example, physical presence, economic nexus, sales and use, and franchise. A, yes, we are confident in our state tax compliance. B, we know enough to be dangerous. Or C, no, and we need to learn more. And while you're taking a few moments to answer that, I know Brittany just plugged our individual webinar for Tuesday. I do want to give a quick plug for our advisory webinar on January 15th. So our consulting group under the name Clark Schaefer Consulting has a webinar January 15th. And for those of you that aren't aware, our consulting group does everything from data analysis to cybersecurity, IT risk and controls, a whole lot of things that maybe folks wouldn't consider services under a traditional accounting firm. But our next speaker actually leads that group, and I'm certain that he will be on that webinar again on January 15th. So again, if you're interested, we would love to have you, and you can register through that gray box in the webinar here. So,
and Brendan, I'm just going to jump on real quick. I know we're going to get close on time, so I wanted to announce for the audience that we will likely go over. We have another presenter who's getting ready to start. This webinar is being recorded, so if you need to drop off, feel free to do that, and the webinar recording will be sent to you later today.
Great. Thanks, Carrie. With that being said, Phil Hurak is going to give us a state and local tax update. Phil.
Okay, great. Thank you. Well, and we will try and be expeditious here and work through this. So state and local tax overview for 24, we continue to see a lot of new legislative activity as a result of these very odd economic conditions we're in. We're seeing expansion of tax bases. So states essentially looking for new areas to capture tax from either new or existing constituents within their state. We're certainly seeing an increase in audit activity across the board, yet another way to generate incremental revenue, and following along with the theme of generating additional revenue, nexus standards are changing across states, ideally with the point to pull in more businesses into the state to, again, drive incremental revenue within those states. Zach mentioned PTET. We now have over 30 states that offer this. I know we've had a lot of clients in 2024 elected and will continue to likely in 2025. I think the big, as Zach walked through, the big question is what happens post TCJA and what happens once that SALT cap rolls off. obviously we'll be staying on that. But for 2025, if you've not looked at it in the past, it's certainly something to look at. Side note, we're also seeing states take a higher audit look at PTET. Often they're complex in claiming, and states are very often taking a second look at those. I mentioned income tax nexus expansion. Really, this is the whole concept, and we've talked in years past around Wayfair, but it is the growth of this economic nexus concept. So historically, if you didn't have people or property located in a state, many taxpayers would argue a 86-272 position if they're selling goods, and states are really starting to push back on this. They're pushing back on the requirement of a physical presence. They're adding additional factors to what generates nexus within a state. And so being aware of your footprint, just because you've not filed in a state in the past, doesn't mean you should not necessarily look at it in the future. So taking a look at nexus, certainly from an income tax standpoint, but then the corollary as well from a sales tax standpoint makes a lot of sense, especially if you're entering new markets or have been growing significantly in a jurisdiction that you're not presently filing in. Certainly, if you have been operating in a jurisdiction and there are concerns that you possibly did need to file or should have, there's two ways to play it. One is you can wait for the state to come and find you, and there's an unlimited look back period on that. Or you can proactively approach the state through the form often of a voluntary disclosure and come to them. Nice thing about that, it limits the look back, and it also can limit some of the interest and or penalties that you're subject to. So considering VDAs in a world where you might have nexus can make a lot of sense. Just real briefly, this is another example of nexus expansion. We're seeing a lot of states take a look at digital services, digital goods, SaaS products. So anything that you might be selling cross borders electronically, states are really looking at this to grab on as a new opportunity to tax additional businesses in their state. Looking forward, we're going to continue to see additional focus on broadening the tax base. We've seen gross receipts taxes or franchise taxes. We're going to continue to see this push legislatively because, again, it expands the base of who they tax. We're also expecting some shortfalls in budgets due to possible reductions in other in tax receipts, whether from sales tax or income tax. And so states are obviously going to have to look at how do they refill that, because unlike the federal government, they need to balance their budget every single year. To do that, they can either reduce expenses or raise taxes. And I think we're going to see a continued focus in combination on both of those here going forward. From a planning standpoint, and this was mentioned more through the lens of a federal, but both from federal as well as state and local. This is always a great time, and we have this discussion with our clients around looking at your plans. What are your business plans going forward? What does your capital agenda look like? What are you spending on building, machinery, and equipment? What are you spending on hiring? What are you spending on innovation? What are you spending on technology? What are you spending on training? All of these are triggers and levers that can drive both tax liabilities, but then can also drive opportunities for tax savings, whether in the form of structuring and planning or through the form of some form of tax credit or tax incentive based on your plan. So always good to look now prospectively ahead into the year. Have that discussion with your advisor so that they can help direct you around what may be the most tax advantageous way to address some of those changes. Real briefly, and I know there's been a couple questions that have come through, so do want to hit this because this is a bit of late breaking news around the FinCEN BOI reporting. This week, earlier this week, there was a district court in Texas that issued a preliminary injunction against the enforcement of CTA and the reporting rule with the due date of 1/1 of 2025. So they issued a stay on this compliance deadline, and companies are not required. They can. It is optional. So FinCEN is still accepting submissions. Companies can voluntarily file the BOI reports at this time, but at this point, this is the law of the land, that there is not a filing requirement for 1/1 of 2025. What does this mean going forward? I think this is the big question. Certainly, we've not heard a response from Treasury at this point. We are expecting something from them, but it is what we are seeing and hearing from different advocacy groups that it's unlikely that this is going away. But there's certainly a likelihood for an extension. Has to be an extension of some sort at this point. Also, it's sounding unlikely that they will reinstate the 1/1/25 due date. Obviously, that is a mere 26 days away. So I think we all just need to stay tuned around that. Obviously, there are some real penalties for non-compliance with that. Those are not currently in place now, but should a new date come out, those presumably those penalties would be reinstated back in place, thereby putting, again, 34 some odd million businesses across the country responsible for making this filing by whatever due date they come up with. So I'm sure more to come on that. We will continue to keep our clients abreast as that changes, but wanted to direct that quick update. So with that, Brendan, I will turn it back over to you.
Great. Thank you, Phil. And normally, folks, we would go through questions and do our best to answer them. I know there were several questions that were submitted, and certainly appreciate those who submitted those questions. In the interest of time, I do want to go ahead. I want to get to the final polling question. But just so you know, if you did submit a question, we will reach out to you directly and answer that question with you one-on-one. So fear not, we will still answer your question. It will just be directly and not in this webinar today. So our final polling question here: how helpful was today's webinar? A, very helpful. B, good, but I still have questions. Or C, I'm going to need more information and will reach out to my advisor. While you're answering that, I just want to thank everyone again for attending. And hopefully you are able to attend our individual webinar on Tuesday or our advisory webinar on January 15th. And look forward to speaking with you all on those webinars. With that being said, I will turn it over to Allie Kelly to wrap things up. Allie.
Thanks, Brendan. Before we conclude, don't forget to obtain your certificate of completion for credit if needed. If you have any questions about your credit, please email cpe@cshco.com. Finally, I'd like to thank Brendan Walsh, Phil Hurak, Brittany Lawrence, and Zach Gubser for their insight today. On behalf of Clark Schaefer Hackett, thank you for joining us and enjoy the rest of your day.